Okay, so let's start off by having a look at the market, what's been driving it as of late, and what we expect to be some of the key sort of fundamental drivers going forward as well. So this graph that you can see here is looking at a front annual, so summer 26, winter 26 averages for the two electricity and gas markets that you can see there. And you can see the first thing that stands out there is there is a lot of volatility. Now, this is common throughout the markets ever since we had the Russia invasion of Ukraine back in 2021. That sparked a lot of volatility into the markets. The reason why was pre-Russia invasion, we had about 50% of European gas coming directly from Russia. It was a nice stable route. There was very limited need for sourcing alternative supply into Europe, and we had a lot of stability within the markets. After the Russian-Ukrainian invasion, what we saw was everybody moved away from Russian gas. We saw a drop in the Russian transit into Europe, and as such, we had to source that gas from alternative sources. Now, the way that we did that was diverting over to the LNG market, liquefied natural gas, and that's a globally traded market. You've got two major importers, Europe and Northeast Asia, and three major exporters in the US, the Middle East, and Australia. So there's a lot more competition, which then sort of infers a lot more volatility into the market. Now, if you look throughout 2024 and into 2025, two very contradictory years. 2024 was largely a very bullish year, meaning market prices were moving up. 2025 was largely a bearish year with market prices moving down. But some of the key events throughout that period were just starting with that kind of Jan-Feb, that Q1 2025, something that is worth noting because we could end up in a similar situation this year, but it's worth looking at historical events and how they've impacted markets. Jan 2025 and Feb 2025, we had particularly low gas storage levels within Europe after the winter. So large depletion of those gas storage levels, which left us starting 2025, coming out of the winter period with a very low level of gas storage, gas inventories. That meant throughout the summer, there was a lot more focus on having to replenish those stocks and ensure that we had sufficient gas storage to get us through the back end of the winter, the March period in particular. That drives prices higher because any sort of potential impact to supply or where you've got an increased demand through those winter periods, you'll see a bullish effect in prices. Second to that, during April 2025, you can see a notable drop-off, and that was when Donald Trump instigated a load of tariffs globally. The tariffs that he was imposed really dropped demand. It dropped production of goods, and as such, that reduction in demand with a sort of stability of supply throughout that period meant that that economic picture turned quite a bit, and we looked more into a surplus of supply, mainly off the back of the drop of demand, and therefore you saw prices drop off at quite a rapid rate, to be honest. Following that, moving into the summer period, and that's when you had heightened tensions between Israel and Iran. Obviously, things started kicking off there. Now, that was a key thing, sort of supplementary to the Russia-Ukraine geopolitical tensions, was the Middle East geopolitical tensions as well. The Middle East is obviously a key area with regards to oil, with regards to LNG as well. I've already mentioned LNG is one of the Middle East is one of the major exporters of LNG. And some of those tensions even got to the stage of Iran making targeted drone strikes on US facilities within Qatar. Now, Qatar is one of the major exporters of LNG, and there is a Strait of Hormuz, which was potentially at risk of being closed off. It's one of the key transit routes throughout the Middle East. And if that was to materialize during that period, you would have seen quite a significant impact on market prices globally. What actually happened was ceasefire was announced, and as such, a lot of the risk that had been built into markets throughout this period then started eroding from the market. And you can see that from this sort of steady decline thereafter. Moving into Q4, the back end of last year, you saw mild temperatures. We were above seasonal norms for the vast majority. I know it's been cold for the past week or so, but throughout Q4, we were sitting comfortably above seasonal norms. As such, demand was a lot lower, and you just see that drop off in prices throughout. And that takes us to the very end of that graph where we are currently sitting. And you can see market prices are sitting towards their kind of 18 to 24-month lows. So they're very competitive right now, which is good. In terms of the key drivers going forward from this stage, we've summarized just a few, the top three sort of bullish and bearish drivers here. What I mean by bullish means prices will go up off the back of these drivers. Bearish means prices will come down off the back of these drivers. And these are by no means hitting all of those fundamentals that are driving the market right now. These are just some of the key ones that we're trying to sort of convey at this point in time. Firstly, on the bullish side, the underlying geopolitical risk. So obviously, Russia-Ukraine has been an ongoing conflict for a number of years now. If anything was to escalate there, we're going to see that knock-on effect in markets. Likewise, between Israel and Iran, that's relatively calm right now. But again, if things start to escalate again, the potential knock-on effects of key transit routes, for example, will have more of a bullish effect. But the more recent one that we've seen as well is Donald Trump and Venezuela. That's another geopolitical risk there, which has the potential, and it's not necessarily that instance itself, but it's the potential knock-on effects of other instances that could occur thereafter that would have that underlying upside effect. The fact that Donald Trump has gone in and almost taken ownership of Venezuela almost opens the rights for other world leaders to start replicating that kind of action, and that's the potential risk that we see here. Second to that is weather. We've moved into sort of extreme weather conditions at the minute. We've moved into sort of sub-seasonal normal levels right now, and the forecasts are looking a little bit cooler going forward. As such, when you get into the height of winter, you get colder weather, you see an increase in heating demand. That will naturally deplenish those gas storage levels, which you can see as the final point on there, and naturally will have a bit of an upside effect on market prices if that is sustained. EU gas storage levels as well, we are still sitting lower than we were in previous years. We're about the 60% level right now, which, if temperatures stay relatively mild, should be sufficient to get us through the rest of the winter. But the more that we see colder temperatures, the more we will withdraw from those storage levels. And the more, it's not necessarily having enough gas storage to get us through the winter. It's more the case of what is the starting point post-winter for the replenishment of stock thereafter, ready for next winter. In terms of the bearish drivers, LNG availability. So we've had a good level of LNG coming across into the European market over the past year or so. That's helped by a relatively muted Asian demand as well. Asia is the largest importer of LNG globally. Europe is a close second. But with Asian demand being relatively low as of late, it means that a lot of that LNG has been diverted towards the European market, which is good for us. So we've got a healthy supply there. And when we look forward into future years, there is additional projects coming online in the US, which should increase that supply into the market as well. Second to that is geopolitical premium easing. Now, I know I've put geopolitical risk as a bullish driver. It is also a bearish driver right now. So a lot of the what if scenarios are bullish. If things escalate, if things materialize, you will see the upside effect. But right now, what we've seen is things have remained relatively calm. We've still seen sort of healthy supply globally. And as such, we are seeing the risk that had been built in previously into market prices easing. Likewise, you could look at that Venezuela situation as well. The additional oil and the potential impact of that being sold into the market, albeit that's not an overnight thing. That will take a long period of time to do so. That would increase supply as well, so potential downside from that. And then finally is reduced global demand. So after 2021 and 2022 price spikes, naturally there's been a bit of a sort of mindset shift in overall consumption. People are sort of looking towards their sustainability efforts as well, so reducing their carbon impact and as such reducing their consumption. Likewise, if you look at the Asian side of things, they've had a relatively weak economic recovery off the back of COVID, and as such, their demand's a lot lower than it has been in previous years. So that reduced demand overall is just helping ease prices a little bit at the minute. If we just look at that forward curve as well, so this is a snapshot of prices going forward for each of the months you can see in the graph there. This whole curve will move up and down day to day, but it just gives us a view of where the general trend of prices is. It's not a forecast of prices. It's not expecting where prices will move. It's just looking at a snapshot of those future prices as they stand right now. And the key thing to take away from this is what we can see, which is a term called backwardation. And that's meaning that each subsequent year that you can see is trading at a discount to the previous year. So you can see the winters naturally trade higher than the summers, but year on year, you're seeing that step down in the overall price. And that's a term called backwardation. Why is that important? It's important because it means that right now, if you're trading forward, if you're trying to hedge into future years, you can benefit from that discount pricing from a fixed or a flex perspective. If you're on a fixed contract, naturally you will be fixing into future years. If you're doing a 24 or 36-month contract, you'll be capitalizing on this a little bit. That being said, that's the supplier's risks, so they will build in a risk premium that will offset some of that benefit. On the flex side of things, if you've got a contract that runs out that far, it gives you the opportunity to start building a position, start trading some of that price into future years, which allows you to start stabilizing your price. Some of the other key fundamentals that we're just keeping an eye on, we've mentioned already EU gas storage. There's a little bit of information here on it. I'm not going to delve into too much detail. I think the key thing to pull from this is we're about 60% fullness right now in Europe, which is adequate. It's lower than previous years. It would be nice to be higher than that. And the real focus here is on the sort of level of withdrawals. So you can see this graph in the bottom right-hand side here. This is looking at the net injections into storage. Obviously, that's negative for all this because we're withdrawing as opposed to injecting into storage. And it really is a question of what level are we going to be at post-winter and what does that replenishment need to be over the summertime to put us in a good position going into winter 2026. You can see here a map as well of just where that storage percentage is across each of the countries. The reason we look at it from a European perspective and not just a UK perspective is because the European market and European gas storage levels are much higher. Germany has a huge gas storage facility as opposed to just the UK. So you've got to consider the whole picture, especially with all the interconnectors as well. Second to that as well, LNG, we mentioned this previously. So I think the main point here just to touch on is around sort of that general global flow of LNG. Like I said, you've got three major exporters, the US, which tends to feed the European market. You've got Australia, which tends to feed the Asian market. And then you've got the Middle East, which kind of goes between both the European and Asian market. And then you've got two major importers, which is your Asian import and your European import. The Asian market is the dominant one there. So when they really need additional LNG, they tend to get it, and a lot of cargoes get diverted that way. What we want to avoid and what we want to keep an eye on is if we end up in a situation where both Europe and Asia are looking for additional LNG at the same time. So take, for example, cold snaps. If they occur in both regions at the same time, demand goes up for heating. As such, they turn to the LNG market to source that additional demand. What you'll tend to get is a bit of price competition. That'll increase your volatility, increase the price at more of an exponential rate, and as such, you'll see a lot more of a bullish movement within markets. I did mention previously that there are a number of LNG projects that are ongoing at the minute. This just gives you a quick snapshot of those LNG projects when they're expected to come online. You can see going into 2026 and 2027, we're seeing a lot more of those projects come online. That'll help add additional supply into the market, which is always a benefit. The more supply you've got, the more that should ease market prices. But that being said, it's not the only driver in UK energy markets, so it just needs to be taken with a bit of a pinch of salt. But it's always good to see additional supply coming into the market as well. A lot of those are currently under construction, with a lot of the commissioning days going into kind of the next 2 or 3 years, really. Put a slide in here just on the wider commodity complex as well, because it's worth noting, just keeping an eye on Brent crude, carbon prices as well. Brent crude is one of the key kind of benchmark prices for just general commodities across the globe. The sentiment taken from oil typically ripples throughout several of the markets that you look at. It used to be that oil was the main driver of UK gas and electricity prices, less so these days. LNG plays a big part, but you've also got carbon prices in there as well. It's worth just noting that. But I won't delve into too much detail there. In terms of that general market sentiment, what we're doing here is just trying to assess where we think short-term, mid-term, and long-term prices may sit. And again, this doesn't account for any fundamentals that are unforeseen. So if we get something that kicks off that is completely unaccounted for, that's going to change this altogether. But as it stands right now with the fundamental landscape, what we'd expect is the shorter term prices, so how prices will move over the next few days to the next few weeks, is probably looking a little bit more bullish right now. And that's because we've seen sustained downside for a period of time. Naturally, you would expect a bit of a retracement. You'll end up with kind of trader behavior almost. Once markets have dropped so far, traders start to buy. And as you get more people buying into the market, that's a perceived demand. So you'll see that increase. And as such, markets will turn. Vice versa, when markets have been in a sustained upside or a bullish rally, you'll get people selling off into the market as well. And as they sell, more and more people sell, that'll turn market price down. And as such, you'll see the reversal there. But right now, we're sitting in a bit of a bullish kind of trajectory in the short term. Mid-term, when you're looking over the next 1 to 6 months, it is still slightly bullish, but I'd say it's a little bit more neutral than what we're expecting short-term wise. And then when you start looking longer term, 6 months to multiple years, we're sitting more in that kind of neutral camp with that. The market's a little bit uncertain at the minute. There's a lot more volatility. And when I say it's neutral, that doesn't mean that volatility is going to decrease. We're still expecting high levels of volatility, but it'll be range-bound volatility. So week to week, month to month, you will still see prices move quite a lot, but the underlying trend should be somewhat neutral over that period of time. And again, it's worth reiterating that is subject to change based on unforeseen fundamentals as well. Okay, so let's get into flex renewals and how we can make them simple. So the real purpose of this here is looking at the value of a flexible approach over a fixed approach. The common sort of statement that we get from a lot of clients is fixed is the low risk option. I know exactly what I'll be paying, and it's the budget certainty side of things, which is true. If you've got a real low risk appetite, it gives you that budget certainty. What you need to consider with that though is the risk sits with the supplier. As such, they will build in additional risk premium into that. So the longer term that contract is, the more risk will be built into that because the more of that risk is sitting with the supplier. The other thing to consider as well is you have a single fixing date as well, almost one opportunity to try and hit the best price possible. If I was to say to you, you've got a 1 in 365 chance, I would say that's pretty high risk as opposed to low risk from my perspective. So whilst it's sort of deemed as low risk, it's actually a little bit more medium to high risk than people would say. You've also got that timing risk as well. So you are sort of hedging your bets that the market will be at the most favorable price on the day that you place that fixed contract. When you're looking at flexible contracting, what you're doing there is you're allowing you to spread your risk over a period of time. You're not really being susceptible to the extremities of the market in such a short-term period. So typically you would get a 3 to 5 year contract in place, and as such you'd be trading that in increments over that period of time, smoothing out the extremities of the market, trying to get around the market average or better. That's what you want to be trying to achieve, really. It reduces that risk to kind of an all-in fixing risk, if you will. And it gives you the flexibility to access the market when the price dips. So it gives a little bit more control and risk management effectively over your energy spend. And I think the key takeaway here is that flexibility is about risk management, not market timing. Obviously, if you can time the market perfectly, that is great. But realistically, the market is a very volatile thing, particularly these days compared to pre-COVID periods. So it's about trying to spread that risk over a longer period of time as possible and ensure you've got continuity of price as opposed to large swings, having a year of a relatively competitive price and then a year where you're extremely high in terms of your energy spend. You're trying to spread that risk as best you can. Just looking back over our gas and electricity baskets, so you can see here gas hedging WIAC now. What this is viewing here is a view of our performance on our gas baskets as an average. We've got several gas baskets, several electricity baskets, but this is an average performance over that period of time and into future years as well. So the shaded area that you can see there is the extremities of the market and the trading range which the market has traded. So throughout 2024, you can see high levels of volatility. You can see the market reach some pretty high levels. And as you go forward, that trading range has narrowed somewhat. The blue line on here is showing you a 24-month market average. So had you sort of been making one trade every single day for the 24 months prior, you would have achieved that sort of level. And then the orange line shows you where the basket average has been. So the performance of Optimised in those gas baskets over that period of time. The key thing that you want to pull away from this is throughout 2024 and sort of the first half of 2025, we were well below that market average level, sort of sitting towards that lower end of the market range. And then going forward for future years, you can see that step down in price. The actual price that's achieved so far is showing a year-on-year benefit, basically. And that's pretty much in line with that market average. And again, towards the lower end of that trading range. We don't adopt extremely high risk baskets. We adopt a relatively medium risk basket in which that you're not trying to target the absolute lowest price, because if you're going to target the absolute lowest price off the market, you must incur the risk of achieving the absolute highest price of the market. What we're trying to do here is beat the market average and get towards that lower end. And the fact that this traded line is sitting towards the lower end of that range throughout this period demonstrates that we're managing to do that. It's about having a solid risk management strategy in place to make sure that we can protect price risk or mitigate price risk whilst trying to achieve a competitive price at the same time. And I think that graph demonstrates how well we're doing with that. Likewise for the electricity, same graph, same visual that I put here, but just for the electricity rate. So again, you can see the trading range of each of those periods, narrowing as you go further out, and you can see the market average. Again, throughout 2024, we were competitive to the market, as with 2025 as well. And then going forward for future years, we're pretty much sitting around that market average as well right now. But again, you can see that sort of continuity of commodity price. All of this on this slide and the previous slide is just in relation to the commodity, not the non-commodities and supplier fees. Why is that important? Well, when you're looking at flexible contracts, the supplier fee is such a small part of it. When you look at the management fees that they put into it and the shape and risk fees, if it's on a base load product, it makes up such a small amount of it. The non-commodities, they are published charges. There's very little you can do to affect that. They're non-negotiable charges. They just either are fixed by the supplier, which will tend to include a risk premium, or they can be passed through at cost. So the supplier will get charged by the network operators, etc., and they'll just push that through straight onto your bill. The only way to really avoid cost there is by looking at your consumption, reducing consumption, reducing capacity, for example. That's where you can impact those. You can't really impact that through the market. The bit that we have really got control over is that commodity, that raw commodity. That's the bit that we can really influence. And you can see on here, we're about 40% on electricity, and this will vary meter to meter, portfolio to portfolio. And we're about 84% on gas. So gas, we have a much bigger influence, but electricity, we've still got a substantial influence. When you go out to market tender, all you're really doing there is comparing supplier management fees, supplier shape and risk fees. They're very small amounts of the overall bill. Realistically, the takeaway here is that the ability to act in the market, so having that ability to trade, having that contract in place, is more valuable than negotiating fixed supplier fees. You might save a small portion on your supplier fees by going out to tender, but in the time it takes you to do that, you're missing opportunity within the market. You're better having that availability to trade, and then you can capitalize as best you can during that period. So what's the next steps in terms of renewal timelines? Well, realistically, if you've got an April 26 renewal, we need to be moving ASAP. We showed previously that the markets are in a very favorable place right now, so we need to have that access to the market. And it goes back to that. If you don't have a contract in place, we can't act, we can't trade on your behalf. So we really need to make that the priority right now. What I would recommend you do is review performance to date. So have a look over your previous contract, over your previous bills, see how they've performed and how that aligns with your kind of objectives. Engage with Optimised. So your CRM should be in contact with you already. If reach out to them, have additional conversations as well if needs be. But we really need to be engaging with Optimised where we can. And then from there, we need to get early market access. The more we have a run up to actual delivery, the more time we have in the market, the more we can impact that commodity price. And then finally, enter April 26 with control and certainty. So once we've got that contract in place, we can start trading that volume. We can start securing your price, mitigating market price risk, and then you can go into 2026 with a little bit more certainty. Right now, you're fully exposed to the market if you've not secured your April 26 contract. And as such, if we see things escalate, if geopolitics increase, if we see that risk increase and we see the market react to that, then you're fully exposed to that. Having that sort of market, having that framework in place allows us to start mitigating that market price risk. Okay, so that's everything from a market perspective and kind of looking at products. I think I just wanted to touch back on just a few of those key takeaways there. So market conditions right now, very favorable. Forward prices are at the lower end of recent ranges based on where our baskets have been traded. So they're in a very competitive position right now. They've consistently delivered value throughout our risk management strategies, which is good. The current forward positions, it's showing that year-on-year benefit right now. That is still subject to change as we trade more, but right now the market's in a competitive place, so it should remain something similar to that going forward. Market volatility is still elevated. That reinforces the need to try and mitigate that market price risk. Have that contract in place, start hedging your position, and start mitigating that price risk. And the way that we can do that is ensuring that you've got a contract in place as early as possible. We cannot act if you don't have a contract in place. And then it just harps back to sort of reminding you that commodity price is the bit that we can influence. That's the main bit we can influence. And that is the majority of the cost that you can influence. That has more value in ensuring that you can manage that as opposed to sort of tenders on small supply management fees, for example.